This wasn't about steel. It was a test of who controls the rules. On June 4th, the White House confirmed a move that doubled steel and aluminum tariffs to 50%. Weeks later, on July 31st, another order raised tariffs on Canadian goods to 35%, effective August 1st. Those dates matter because they mark an escalation inside one of the world's most integrated industrial relationships. The headlines focused on retaliation, on who would strike back. That's not where the real shift happened, because tariffs are loud, rules are sticky, and Canada's response wasn't built to win a news cycle. It was built to raise the cost of pressure over time. Here's what actually matters. Based on publicly available reporting, the sequence is clear. The United States escalated tariffs on Canada in mid-2025. One order raised steel and aluminum tariffs from 25 to 50% under Section 232, effective June 4th. Another raised tariffs on Canadian goods to 35%, effective August 1st. Those are blunt instruments. They operate by increasing prices at the border. They're fast, visible, and politically legible. But they also have limits, especially inside supply chains that are tightly coupled. Canada and the United States don't trade at arm's length. Autos, construction materials, energy inputs, and manufactured components move back and forth across the border as part of single production systems. When tariffs hit one side, costs often echo back. That's why this isn't just about the size of the tariff, it's about the structure underneath it. And that leads to one question. If tariffs were the opening move, what did Canada do next? Tariffs raise prices. They don't automatically create alternatives. In deeply integrated systems, firms can't instantly switch suppliers, redesign factories, or reroute logistics without friction. The result is often higher costs, uncertainty, and short-term disruption, but not necessarily durable leverage. That's the constraint. It's also why responses that focus only on matching tariffs can stall out. They escalate noise without changing conditions, which is where Canada chose a different path. On July 16, 2025, Canada announced a package of steel measures that did not mirror U.S. tariffs. According to the Prime Minister's office and the Canada Gazette, the government introduced tighter import controls designed to manage diversion, including tariff-rate quotas. It also imposed an additional 25% tariff on certain steel imports containing steel that was melted and poured in China. These are technical measures. They don't sound dramatic. They don't read like retaliation, but they matter because they shift the terrain from price shocks to conditions of access. Rather than matching tariff for tariff, Canada narrowed who could sell into its market, under what terms, and with what documentation. That's not a headline move, it's filtration, and filtration changes leverage. In Ottawa terms, this isn't dramatic, it's procedural. And that's the point. Procedures endure. They don't expire with a press conference. They shape behavior quietly over time. It's worth pausing on how these tools actually function. Tariff rate quotas don't ban imports. They set thresholds. Below the threshold, trade can continue under defined terms. Above it, costs rise sharply. That creates incentives to reroute, retime, or reduce volume. Origin-based measures, like focusing on where steel is melted and poured, don't target countries rhetorically. They target production realities. They require documentation, verification, and compliance across supply chains. All of that adds friction, and friction is leverage. Because unlike tariffs, which can be lifted with a signature, rule-based measures are embedded in processes. They involve regulators, customs authorities, and compliance systems. Reversing them isn't instant. It requires review, justification, and political trade-offs. That's the strategic distinction. Here's the mechanism most coverage misses. Tariffs raise prices at the border. Rule setting raises costs across the system. When a country tightens import rules through quotas, origin requirements, or procurement standards, It doesn't just make goods more expensive. It changes incentives. It forces producers to recertify, reroute, or exit. That's slower, but it's harder to unwind. Taken together, Canada's move suggests the response wasn't about symbolic retaliation. It was about tightening conditions in ways that can make pressure tactics more expensive over time. Not impossible, just costlier. And that distinction matters. There's a useful comparison that helps clarify this logic. In March 2025, Ontario announced a 25% surcharge on electricity exports to several U.S. states, citing tariff pressure. That move wasn't a mirror tariff. It targeted a bottleneck. Electricity is not easily substitutable in the short term. It flows across borders through fixed infrastructure. When Ontario adjusted the terms, it didn't need to threaten escalation. The leverage was implicit. This is the same principle at work. Pressure only works when there are no alternatives. When alternatives exist but are more expensive, slower, or procedurally complex, the cost of coercion rises. That's deterrence by design, not escalation by rhetoric. Zoom out further, and this fits a broader global shift. Trade is moving towards standards-based access. Carbon intensity, origin rules, and compliance regimes are becoming gatekeepers. The European Union's Carbon Border Adjustment Mechanism, CBAM, illustrates this shift. The European Commission states that CBAM operates under a transitional phase from 2023 to 2025, with its definitive regime applying from 2026. CBAM doesn't ban imports. It prices carbon at the border and requires reporting and compliance. Again, this isn't loud, it's structural. For exporters, the challenge isn't a single tariff rate, it's the cumulative cost of meeting standards across markets. Canada's July 16th steel measures sit inside this trend. They don't claim exemption, they don't declare victory, they align policy with a world moving toward conditional access. That alignment matters more than any one tariff line. The timing here is important. During the CBAM transition period, firms report emissions but don't yet face full financial adjustments. From 2026 onward, compliance becomes consequential. Documentation, verification, and pricing all matter. That creates a premium on predictability and standards alignment. Canada's approach, focusing on rules, origin, and managed access, signals an understanding of where trade is heading, not where it's been. This isn't about racing the United States. It's about positioning for the next phase of market access. Precision matters here. This is not proof that Canada won a trade war. That framing is unhelpful. It's also not evidence that tariffs are irrelevant. They aren't. Tariffs can still inflict short-term pain, especially in tightly integrated sectors. What this does suggest is that Canada chose a response designed to endure, to shape conditions rather than chase headlines. That's a different posture, and it changes the math. None of this minimizes the real effects of trade friction on workers in firms. Integrated supply chains means shocks travel quickly. When access tightens or prices spike, uncertainty spreads. But analysis needs to distinguish between pain and power. Short-term disruption does not automatically translate into long-term leverage. The question is, which moves alter the structure going forward? Quiet rules often do more than loud tariffs. Tariffs can be cut with a signature. Rules require processes. Once quotas are set, once origin standards are codified, once procurement guidelines are written into funding frameworks, reversing them involves consultations, legal review, and political trade-offs. That's friction. Friction raises the cost of future escalation. It narrows room to maneuver, and it signals seriousness without spectacle. There are limits. Canada cannot insulate itself from every external shock. The United States remains its largest trading partner. Integration cuts both ways. Rule setting also carries risks. It can invite challenges. It can complicate compliance. It requires administrative capacity. That's why this shouldn't be read as triumphalism. It should be read as positioning. From here, three things matter. First, durability. Do these measures hold under pressure, or are carve-outs expanded quietly? Second, alignment. Do partners move in similar directions, reinforcing standards-based access? Third, scope. Are similar rule-based tools applied in other sensitive sectors, or does this remain contained? Those answers will determine whether this was a moment or a pattern. Tariffs made the noise. Canada adjusted the structure. Based on publicly available reporting, the response wasn't about matching force. It was about changing conditions, tightening rules, controlling access, and raising the cost of pressure over time. That doesn't end friction. It doesn't guarantee outcomes, but it does change the math. And in geopolitics, changing the math is often what matters most.